We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrix. Joining me today is Eric Yueng. He was a contract manufacturer in China and now a gold investor. Eric, thanks for joining me today. How are you?
I'm doing good, Tom. Thank you. It's a pleasure to be on your show.
Well, I'm looking forward to this conversation, and it's a pleasure to speak with you as well. And of course, we have this, let's say this giant development that we really need to break down and take some time to explain and to lay out for listeners. And that being this explosion, let's say, within the EFP premiums and all of this noise around the LBMA. Why don't we start by laying out what the actual problem is, and I can stop you in the middle and ask for some definitions and stuff like that. Because this is, at this point, it's a lot of noise. And I think, as always, what I try to do is take a step back and look at all of these systems, let's say, in a longer term view to get this longer term perspective. Obviously, again, this is making a lot of noise right now, and this is seeming to be a catalyst for a higher gold price right now. So why is that, Eric?
Okay, so Tom, as you probably know right now, the LBMA has a situation with their physical gold delivery. The FT, which is the Financial Times, has reported on January 29th that the LBMA delivery time for physical gold has went from T+2 or T+4 to T+30 or T+60. So instead of 2 to 4 days of delivering your gold, now it takes 30 days or maybe 60 days. That's from the Financial Times. And then since then, the LBMA came out and they did a webinar. They tried to explain that the delays are due to bar size differences, markings, etc. That's the explanation. Now, we're going to put that aside for a second. We're going to look at the COMEX. The COMEX, and this is reported by Bob Keynes and from COMEX data, in the month of December and January, the amount of physical gold that stood for physical delivery was 498 metric tons. Now, that represents 15 times of normal volumes. So somebody really want their physical gold. Now, we know that most of that is probably intended for withdrawal because of the situation at the LBMA, because of the T+30 or T+60. Now, back to the COMEX, in the month of February, Rob has reported, this is a week and a half ago, that there's 200 metric tons of physical gold standing for delivery. By the time that the delivery time comes, I'm thinking that number is going to get to 250 metric tons. So do you have any questions at this point?
Basically, the biggest change, I think, is that these parties, obviously there's more demand, and they're also specifically standing for delivery. What does this mechanism or this market usually, what is it usually used for?
All of a sudden, there's 15 times physical delivery. But normally, how does it work? When it wasn't 15 times physical delivery. Normally, most of the contracts at the COMEX are settled by EFP mechanism. That's a mechanism.
The exchange for physical.
Exchange for physical. Yeah. Don't let the name deceive you, because a lot of it is just basically cash settlement from what we call a COMEX LBMA trading pair. And that's what the experts talk about all the time, like Bob Coleman, the EFP trading pair. So what people would do, what bullion banks would do, is that they would short the COMEX and they would long the LBMA. And then they make an arbitrage, right? So let's say I'm just using an artificial kind of price. Okay? Let's say the gold at COMEX is $99 and the gold at LBMA at their cash promissory note market is 99.50. So if you're short at the COMEX and long at the LBMA, you have a 50 cents arbitrage. So that's how they make their money. I know that it's not exactly how it works, but I'm trying to simplify it for your viewers so that they understand, right? Like, approximately what is happening. And that is what it is. The EFP trading pair. Mm-hmm. But in this scenario right now, there's 15 times physical delivery demand at the COMEX. What happens? What it means is that a lot of players are insisting that they want the physical metal. They do not want to cash settle. They want the physical metal. So the physical metal demand, naturally, a lot of it is being fulfilled by the LBMA for physical delivery. And then they ship it off to the COMEX to physically deliver to the buyer. But that creates a problem because of the T plus 60, because there's more demand than supply, essentially. That's what it is. I mean, the LBMA says that they have 8,000 metric tons of physical gold in their vault, at the Bank of England vault. But that's probably not allocated gold that they have access to, right? That's why right now it's T plus 30 or T plus 60 for their physical gold delivery.
And what's that? Just explain what T plus means.
At the time when they request delivery, when the contract allows the customer to request delivery, it takes an additional 30 or 60 days for the seller to produce that physical metal delivered to the buyer. So
and normally it's like 2 days, and now it's gone to 30, if not 60, right?
Yeah, it's not 60. And Andrew Maguire actually said it's 90 from his insider contacts at the LBMA. But let's just take the FT number and say it's 30 and 60. So right now it's 30 and 60. So what happens? What's happening? And this is public knowledge. What's happening to the promissory note at the LBMA? It's trading at a discount because you're not getting the physical metal. It's a forward contract now. It's not spot. It's not a spot contract anymore. You're not getting the metal right away. You're getting it 30 to 60 days down the road. Mm-hmm. So that's taking a haircut, that contract. Let's just say it's $96 in our little model here. So that's a big problem because before you were making 50 cents. Now you're losing $3. So what happens? All the people who are trapped in this EFP trading pair, they don't want to cover the shorts at the COMEX because covering the short is expensive, more expensive than if they force or if they persuade their seller at the LBMA to deliver them the physical metal. So there's a scramble. Everybody wants physical metal at the LBMA to deliver to the COMEX so that it can be the contract can be fulfilled without having to cash cover the short position at the COMEX. That is what's happening. Let's say this situation aggregates. It doesn't resolve itself. And only certain people, or no, let's just say 70% of the people get the physical metal so that they can go to the COMEX and deliver. What happens to the 30% of the people who can't get the physical metal? They are forced to cover the shorts at the COMEX. And then what happens? The price of gold will spike up from that short covering.
Because there's a recognition that they can't actually get what they've asked.
Because they can, because short covering paper is more, it would impact the price more than physically delivering the metal under contract. Mm-hmm. That's what happens, right? That's just how the COMEX works. So they cover, the price goes up. It's like a short squeeze. That's what's happening.
So Eric, do we know who is standing for delivery and who's still short?
So I believe James Anderson is kind enough to give me a chart of the loadout of all the parties that are involved at the COMEX in the last 16 working days. So shall I read who the deliverers and the receivers are? I'm going to do that. Top deliverer at the COMEX for these gold contracts is HSBC.
So are they the seller?
They're the seller. 15,577 contracts. JP Morgan, second biggest seller, 14,850. Morgan Stanley, third biggest seller, 13,354. HSBC is doing it on behalf of the customer. JP Morgan and Morgan Stanley doing it with the house accounts. Now, who are the receivers? Who's the biggest receiver? JP Morgan, 20,000 contracts. They're doing it on behalf of a customer. Barclays, 10,234 contracts. They're doing it on behalf of a customer. Bank of America, 7,234 contracts, house contracts. So do you see a pattern, Tom? What's happening?
Seems like they're all doing it for somebody else.
Yes. And based on all the evidence, 15 times physical delivery at the COMEX, if it's just a random bullion bank or a hedge fund or a family office, you think that either the seller or the exchange, I'm talking about the CME COMEX, do you think that they would stand for that, or do you think they would force cash settlement if it's just a random player trying to disrupt the exchange? That's the question to you.
Yeah, they clearly somebody wants physical.
Yes. Mm-hmm. I think in my thesis is that a lot of these bullion banks who are taking huge physical deliveries at the COMEX, US government proxies or Federal Reserve proxies. They're doing it on behalf of the US government or the Federal Reserve. The reason is because Donald Trump told you today, they're going to audit Fort Knox. And a lot of people have been wondering if the gold is all there at Fort Knox all these years. Mm-hmm. Correct? I'm sure you get people asking you on your X account, on your China as well, right? Is the gold there? Well, yep. The gold probably is not all there. So they are racing against the clock to repatriate the gold from overseas. That is what is, in my belief, that is what is happening. To be fair, if you are a bullion bank working on behalf of the US government as a proxy, aren't you going to import some gold for your own books if you know what's going on?
Yeah, because if you have, let's say, if you're working as a proxy for, I guess it would be the Treasury, to repatriate this gold and you have this information, you're going to say, hey, there's obviously money to be made here because of this premium and this disparity in the values between these two markets. As you say, you have this insider information, so you're going to try to get in on that as well.
Well, if you are a bullion bank and you know the US government is going to audit Fort Knox and potentially revalue the physical gold in US government possession to mark-to-market prices. And that's what I believe is going to happen, by the way. If they're going to revalue, it's going to be revalued to a mark-to-market price. Mm-hmm. Okay? If they believe that. And that's a very strong signal, by the way. If they revalue it to a mark-to-market price, I think gold is going to go up from that point on. And if you're a bullion bank, you know that, you want some gold on your own books so that you make, at least on paper, you make money, you make profit on your books of the gold that you're holding, right? And of course, there's another aspect to this as well that we haven't talked about. Basel III is going to be implemented in the middle of the year. I think it is July 1st in the US. What does that mean, Basel III? All the gold, physical gold in the US under these banks would become tier 1 capital. But paper gold is going to take a haircut under Basel III rules. I believe it's going to be something like 15%. But physical gold that is allocated is going to be basically deemed as tier 1 capital. This also may be a reason why all the bullion banks are joining their own mission as US government proxy to import physical gold back to the US.
Right. Because of that difference. What does physical gold being a tier 1 asset mean? And there has been, let's say, Basel III, let's say, regulation has been implemented, but they had time to actually adhere to these regulations, right?
Yes. So what does it mean? US dollar cash is tier 1 capital. US Treasuries is tier one capital. Now gold is tier one capital in the US. So it just means it's pristine collateral. That's what it is.
Mm-hmm.
You know what? It's just in time for the US to potentially take their physical gold after they revalue it and use it in their US Treasury bonds to create US Treasury gold bonds.
Right.
Long duration, right? This is something that Judy Shelton has proposed. Did Judy come on your show, Tom? I think she did,
yeah.
Right? And she explained all this, right? So, you know what's interesting? I read Judy's book and I understand what she's trying to do, what she's proposing. And then Jim Bianco came out last week with this theory because Jim has DC connections. And he's saying that in order for the US government to control the out-of-control debt, the Trump administration potentially will, I'm going to use this word in quotation marks, okay, force US allies to convert a large part of their US Treasury bond holdings to a zero coupon perpetual bond. That's what Jim Bianco said. Okay, you see the utility in that. If they do that, then right now the US government pays more in debt servicing, in interest rate payments, than what they're spending on defense, on the military. So if they do that, they force allies to switch to these long duration US Treasury bonds. Well, he said perpetual bonds with zero coupon, then you're cutting down the interest rate payments significantly. So I talked to Jim and I said, hey, you can't do perpetual. It's not going to work because that's essentially saying you give me the principal, you never get it back. So I said,
and what does that do to the value of U.S. debt? Completely destroys it.
Exactly, right? So what is it that makes sense? What Judy is saying. Instead of doing a perpetual bond, you do gold-backed U.S. Treasury bond, 50 years, zero coupon. You decrease your interest rate payments significantly, but at the same time, your ally is not completely destroyed by inflation because that bond is backed by gold, as Judy Shelton has suggested.
Mm-hmm.
So see how everything fits together? That's what I think they're going to do. That's why I think they're going to order the gold and revalue gold. One big main reason is because, I just explained, because of Judy Shelton's proposal of this physical gold US Treasury bond.
Eric, this is such a, let's say, a fast moving situation right now. And this morning I saw two different stories about Besant coming out and saying, look, remonetizing the balance sheet. When he said that, the assets held on the balance sheet, he has now clarified that he didn't specifically mean gold. Why would he come out and say that specifically as well?
Okay, so if you're Scott Bessent and you've instructed Jamie Dimon of JP Morgan and other bullion banks to help you repatriate, I'm putting that in quotation marks, physical gold back to the US. So you are a big buyer. That's a fact. 250 tons this month and 498 in the last 2 months through the COMEX. And by the way, Ronan Manley posted something saying that in the last 2 months, the total gold that the US actually imported is approximately 2,000 tons.
Mm-hmm.
So 2,000 tons, think about that, Tom, that's a lot. So if you are importing 2,000 tons of gold and you're still doing it right now, do you want to excite the market by confirming that you're going to revalue gold? Because that will be super bullish for gold.
Mm-hmm.
Everybody, like the cat is off the bag if you miss it. So if I'm Scott Bessent, I will neither confirm or deny these rumors so that the price of gold remains stable below 3,000 US dollars, which is, guess what? Exactly what happened.
So, Eric, where do you think the ETFs fall into this picture, and what has been happening with the demand for GLD and inside the ETFs?
It's a very good question, Tom. For these guys, these bullion banks to get gold, There are essentially two huge piggy banks where they draw the physical gold from. Number one is the LBMA, and we talked about that. Number two is GLD. GLD is the secret piggy bank. So what's happening? I'm sure you see this. The borrowing rate of GLD shares have shot up like a hockey stick. Tom, you see that, right? It's like everybody talks about it.
It's the same chart as the EFP premiums.
Okay, exactly. But we'll talk about EFP premiums after this, okay? Mm-hmm. The borrowing rate went up. Why? Because a lot of bullion banks are borrowing shares of GLD so that they can sell it and withdraw the physical gold. That's what's happening. The physical gold is being sucked out of GLD. Now, the last time I checked, which was two weeks ago, GLD went down from 800 metric tons to approximately, I believe, 660 metric tons. So went down 160. 160 metric tons of physical gold has been withdrawn from the GLD. And I believe that physical gold is being held right now, probably either, like a lot of it, a large portion of it, probably being held on behalf of the US government. And some of it probably, the bullion bank, like I said before, want to put it on their own books to enjoy what is going to come. So that's the part of the ETF. Mm-hmm. Okay? It's piggy bank. It's a physical gold piggy bank for these US bullion banks and the US government. Now, let's talk about the EFP premiums. Why is the EFP premium shooting up? Normally, my friend Bob Coleman said this recently on a post. Normally, if you have a lot of deliveries of physical gold at the COMEX, shouldn't EFP premiums come down? Because it's one big pie, right? If a lot of people are taking physical deliveries of the gold at the COMEX, you don't need to use the EFP mechanism to cash settle, right? So normally the premiums from the EFP should come down. That's what happened in the past before the 15 times blow up of physical demand at the COMEX. Why is that? Let me answer that question. And I actually asked everybody. Nobody said anything, so I'm assuming I'm correct here. I think it's because the players who know what's going on, the bullion banks who knows what's going on, they are jacking up the EFP premiums to discourage the small players, like the family office, the hedge fund, me, you, whatever, to take physical delivery. So they give you a premium. They say, hey, Tom, don't take the physical gold. I'll give you a premium off the EFP. Take the cash. Take the EFP premium cash settlement. Mm-hmm. Everything points to one thing, Tom. It points to the fact that the big gold buyer or the big gold buyers at the COMEX, a lot of them are working on behalf of the US government because of this price insensitivity, in my humble opinion.
So why do you think they have price insensitivity? Is it because they're just trying to get that physical product that
they just want to get the gold? Mm-hmm. The US government just want to get the gold. Mm-hmm. That's it. There is price sensitivity in the sense that they don't want gold to be at $3,500 tomorrow because they're still accumulating, but they don't mind $5, $10 premium.
Yeah.
That's my point. That's it.
Mm-hmm. So Eric, hypothetically, if the gold that the LBMA claims is there, if it isn't there or it's encumbered in some other way, how long would it take their suppliers to be able to come up with that amount of physical gold?
This is an excellent question, Tom. Let's say that scenario happens, right? What is happening right now that we know of? Bloomberg has reported that the LBMA is urging its members to ask foreign central banks to borrow gold. How does that work? A lot of people ask me, and I'm sure you see a lot of these questions on X, right? Who in their right mind in this scenario would lend their gold out to the LBMA? Well, let me tell you who, Tom, do you know what the IMF, the amount of dollars that the IMF have lent out to emerging market countries on average last year?
I have no idea.
$140 billion. Okay.
Okay.
So you are, let's use Argentina as an example. You borrow IMF money. I don't know exactly how much maybe borrow, but let's say $30 billion. That's a placeholder. Let's say he borrowed $30 billion. And the terms and conditions of that borrowing of funds is that you send your physical gold to the Bank of England, so that the Bank of England is the custodian of your gold. And your gold is the collateral for your fiat dollar borrowing at the IMF or whatever Western bank. I'm just using the IMF as an example.
Mm-hmm.
So all of a sudden, you're a EM and emerging market, small country, Argentina. You are beholden to the, not only beholden, you owe Western bank or the IMF. And then but you have your gold there, right? You have your gold being custodianed by the Bank of England. Fine. It might be allocated right now, but this crisis comes about at the LBMA. What happens? You get a phone call from the Bank of England, and then you get a phone call from the LBMA participant who has connections with whoever lent you that money. And they say, we need you to switch that gold, or maybe that gold is already unallocated. That gold will be shipped to the US. And then you, Argentina, will be left with a promissory note saying that in 10 years or whatever, you will get not exactly the same gold bars with the same serial numbers and markings, etc., but you get the same weight and the same quality of gold back from the borrower.
Right.
That's what happens.
Eric, I was going to ask, you brought this idea up that there has been a change here. Who do you think, is this a US change that has brought about this market action? Is this because of China's gold buying and all of a sudden this has come to a head? What do you think this change was sparked by?
I think the Trump administration looked at what is going on and they realized that they cannot kick the can down the road. They really have to head on try to resolve this out of control debt situation. And this is part of their solution of resolving that, basically, is to first order the gold at Fort Knox, revalue the gold, and then to target US Treasury bonds using the gold. And maybe, of course, I was talking to my colleagues, and we are even bouncing the idea of the US government revaluing the gold every year, mark to market, as the price of gold goes up, which means their tier one capital collateral is going up in value. So that's going to be good for the US balance sheet. So that's another possibility as well. There you have it. So overall, I think they're looking at it as a prudent solution, like Bessent was saying, right? I know he denies it, right? But we discussed that. This is what they have on the asset side of their balance sheet. It's the physical gold, and they're going to utilize it. That's what I think is going on.
Mm-hmm.
Yeah.
Eric, what do you think is China's gold strategy here?
So that's a very good question, Tom. China's gold strategy right now is that it's preparing for high gold price. You ask me, what is China doing to prepare for a high gold price? The SGE, which is the Shanghai Gold Exchange, delivered on average for the last 2 years, each year, 1,450 metric tons of physical gold. A lot of that, over 60% of that, consumed by the gold jewelry markets. So as both me and you both know, gold jewelry is a discretionary spending, which means that if the price of gold goes up, it's possible that the amount of physical gold, not in dollar terms, right? But I'm talking about weight, will go down for the jewelry market because it's more expensive for the end consumer. So what China did in 2025 is ingenious. It did two things. Number one is it launched a program at its commercial banks called the Gold Accumulate Program. It basically allowed an individual to open what they call a Gold Accumulate savings account, so that you can put money in there on a monthly basis, and it's just like a savings account. There's a balance, but then you can at any time convert that RMB yen dollar amount in that what they call gold accumulator account into physical gold and withdraw. So that's a game changer, because I have been on other shows in the past and I said to the host that Chinese citizens generally have not yet viewed physical gold as an investment vehicle. But with this gold accumulator program, I see a sea change in the attitude of Chinese citizens. They are now looking at physical gold as an investment vehicle, because it's easy to use. It's easy to withdraw physical gold from the gold accumulator account. So my estimation is that in the first year of this program running, the amount of physical gold that people are going to withdraw from the program, lowballing, by the way, probably going to be 300 metric tons. Okay? So to look back to the gold jewelry situation, if the gold jewelry weight of physical gold goes down because the price goes up, or like per ounce physical gold, what's going to happen is that the gold accumulator accounts at these Chinese commercial banks is going to make up that difference, and maybe even more, because jewelry consumers are price sensitive, but investors of physical gold is a completely different story. Not only that they are not price sensitive, meaning that if the price goes up, they buy less, they might buy more physical gold when the price goes up. So that's very ingenious. And then the other thing that the Chinese government did was just beginning of this month, it announced that it's going to allow Chinese insurance companies, which are the biggest institutional investors in China, to invest in physical gold. Now, that's a game changer, because that's structural demand. And the Bank of America research department came out with an estimate saying that just with the 1% pilot program that the Chinese government is launching with these Chinese insurance companies, the physical gold demand from these insurance companies, Chinese insurance companies, will be 300 metric tons. So think about that, Tom. That's 600 metric tons right there. And that's only the beginning of the gold accumulator program on the retail side. And then on the insurance company side, it's only 1% of all the assets under management. Imagine if that number goes to 5% of assets under management. That will be 1,500 tons per year. They'll almost double what the SGE gold withdrawal amount is per year, just by that. Isn't that amazing? So China is preparing, my friend, for a high gold price. And I believe gold is going to be institutionalized in China as a institutional investment vehicle.
You know, it just seems like everybody, not everybody, but many of these different entities are all starting to recognize the value of gold and really, wanting to take physical delivery of it. This idea that now insurance companies are moving into this space is an interesting and big development as well. And it makes me wonder why, or let's say what the difference is in attitude between the West and the East. I think sentiment is, other than even within the gold community, let's say in the West, I've talked to many dealers and they say they're having to buy back a lot more metal than they're selling right now. So why do you think there's this difference, this cultural difference, or this East versus West difference in attitudes towards gold?
Very good question, Tom. So just like, I think to answer that question, first of all, the Western, I should say the US North American retail gold and silver market is dislocated. It doesn't go step in step with the greater gold and silver market. So like you said, at the COMEX and the LBMA, maybe there's a huge demand for physical gold and silver. But you might see, and in reality, we saw that in the last month or two, that especially in the US, there are more sellers than buyers of physical gold and silver in the retail in the US. Why is that? Because I think, if you ask my true feeling on this, I think in the US, especially the US, I think crypto and Bitcoin has really done its job in diverting retail interest elsewhere. Because a lot of people who buy precious metals, there's the same group of people, a lot, I'm not saying all of them, but a lot of them worried about fiat US dollars, fiat money. They're worried about fiat money. If you have this crypto and Bitcoin as a selection for them, a lot of them would select Bitcoin and cryptos because that's faster money. Like they believe these things move faster. Gold and silver are too slow. So we're seeing the results of that, of years of these cryptos and Bitcoin going up in value in fiat US dollars, attracting people to them versus the gold and silver. Mm-hmm. Whereas in the East, especially China and mainly China, and I hear people from Japan tell me the same thing, and Korea, people, especially the older generation or the middle-aged guys like me, we trust physical gold and silver more than anything else, more than cryptos. We believe that cryptos may be or Bitcoin may be a good speculative vehicle, but they are in no way a stable asset for putting our savings in. Mm-hmm. So I think that's the difference.
So, Eric, when we think about this stepping back again, as I was saying, not ignoring the noise, but stepping back from the current noise, where do you think this puts us, let's say within the next, let's say the short term, within, let's say the next 6 months to the medium term within the next 5 years, let's say? Does this appetite for physical demand keep growing? Does it burn out? What do you think about how this ends up developing?
So if we go with my thesis and believe that a lot of these bullion bank buyers, COMEX, are acting on behalf of the US government, and of course they also doing some for themselves, some buying of physical gold for themselves. If we believe that, then I think they really have crossed the point of no return. Ronan Manny said it in one of his posts, and it makes total sense. He said, if the US government or any entity is doing this not with the intent of breaking the LBMA at heart, okay? Mm-hmm. If that's not the intent, they could have done this in many ways that are more discreet. Because me and you both know there are many OTC markets all over the world. Mm-hmm. They don't need to go through the COMEX and squeeze the EFP mechanism and break the LBMA this way. Really, this is the most ugly spectacle that I've ever seen in the precious metals space in the last 6 years. To answer your question, I think how this is going to end is that the LBMA will, if the demand is sustained at the COMEX in the US and in China, I think what's going to happen is eventually the LBMA is going to break. What I mean by break is that I think the paper promissory notes of gold at the LBMA is going to be they're going to be trading at a significant discount in the sometime future. And when they start trading at a significant discount to the COMEX and to the SGE, that really means that the LBMA as a place of settlement of physical gold is coming to an end. So that is one of the outcomes of your question, sustainable. If the demand of physical gold is sustained in the near future. And the other outcome is what I said earlier in our interview, which is the short covering is going to start happening at the COMEX, which means that we'll see prices at the COMEX for gold gap up. So that's a potential outcome that we need to be aware of, right? It might not happen, but if there's not enough physical gold to be delivered at the COMEX, then somebody some people will have to paper cover their shorts. So those are the two possible outcomes from a price perspective. Okay, that's it.
Eric, do you think that this demand also, as this recognition, or let's say if this recognition of a lack for physical becomes broader, do you think that this ends up bleeding into demand for the miners by let's say the market as well?
Okay, well, you say a lack of physical, right? And I use that term as well.
Mm-hmm.
But there really is no lack of physical if the price is right.
Of course.
Supply is a function of price. That ties into your question, because if the price goes up, then what happens to the miners? The miners' underlying asset is the physical gold and silver, right? So if the underlying asset, physical gold and silver, is going up in price, then the miners are going to have bigger margins, providing that their ASIC, their all-sustained inclusive cost, is under control. And I think it might be under control because we are seeing potentially an end to the Ukraine war, right? And Donald Trump has also invited Russia and Saudi Arabia to a conference in the Middle East to talk about oil, because those are the three biggest oil producing countries: Russia, the US, and Saudi Arabia.
Mm-hmm.
So if the oil price is contained, let's say within 2025 and 26, and the price of gold goes up because of all the factors that we talked about during this interview, then I think the miners will have a much better, much higher, profit margin, and therefore their stock prices will eventually reflect that.
Because of this expansion of their margins.
Correct.
So, but we've had record high gold prices. We've had an expanding margin setup like this. Why do you think that there has not been more demand for the miners at this point?
The cost went up, Tom, at the same time.
Yeah, but
right?
their margins are still bigger than ever.
Yeah, that's true too. I think that part is psychology. Like they're bigger, yes. They can be even bigger. Mm-hmm. You know what I mean? Because the cost went up, like I said, right? But you're right, even with the cost going up, their margins did go up, comparatively speaking. But then now we talk about sentiment. Mm-hmm. And as you know, like I said just now, sentiment for precious metals in North America and miners especially is not very good, because people are in everything else, basically. They want to buy NVIDIA. They want to buy the next greatest quantum computer stock. They want to buy the next meme coin, right? But they are not really looking at miners yet. Mm-hmm. So what we need a major breakout, in my opinion, of gold and silver prices, especially silver, by the way. Okay, the silver is still way below its 1980 high of $50, right? Mm-hmm. So I think once silver breaks 50 and gold breaks maybe 3,200 or 3,500, then the miners will get a bid. But it takes time, my friend. That's my true feelings. I think eventually the miners will get a bid, but it looks like it will take much more than what I envisioned originally. Mm-hmm. Yeah.
Yeah, it's crazy to think that constantly charging through all-time highs over the last, let's say, 6 months especially, hasn't garnered the miners more demand than it has. But I agree, with this hyper-financialization and so many other avenues for people to invest in, this is in some ways an archaic business that isn't on the generalist's radar.
Another thing, Tom, you have chartists on your show before. Mm-hmm. I know that because I watch it. Mm-hmm. And they are, analysts at the big banks. What are they doing? How are they valuing the miners? They are predicting a lower gold price. That's their base model. They are predicting a lower silver price, right? So
not lower, but far lower than it has or than it is right now. So they're basing projections and valuations of these miners off of like a $2,600 gold price, right?
Exactly, right? And we had 2,900 at the futures. So what is a stock price? You're buying the future performance. And these guys are saying the future performance of these miners are crap. So the stock prices of the miners are reflecting that. That's what's happening. But eventually that's going to change. Eventually, the analysts, they have to face the truth, which is the US is remonetizing gold at the federal level and putting it back into the system. And then gold and silver is going to be revalued higher. I mean, silver is a different story. Do you want to talk a little bit about silver? I can talk about it. Do you want to talk about silver? Why the West want to? Yeah. So my theory is that JP Morgan and the Western bullion banks actually helped China to suppress the price of silver because it has always been in China's interest to suppress the price of most commodities because China is a mega manufacturing hub in the world, the biggest, right? And it uses commodities. So China wants cheap silver. In the past, using Sultan Posa's model, the West, they wanted that too. Why? Because the West, like the US or the European countries, they would contract manufacture through China, and China would get a small cut of the manufacturing value chain, proceeds. But the biggest cut of that profit goes to the West, goes to the US. So JP Morgan helped China to suppress silver price. It's good for everybody. Mm-hmm. But what's happening recently in the last 5 years? China no longer need the West. China is manufacturing high-end products, like, high, low-end, everything, from beginning to end, from design to manufacturing to marketing to ship out, okay? Without the West involvement, without the US involvement. Mm-hmm. So in my opinion, it's no longer profitable for the West, for the US, to assist China in suppressing the price of silver. So I think that game is over, and the US is going to let the price of silver go up, so that it can help its own domestic silver mining companies. Because to reindustrialize and to reshore all these industries, the West, the US really need miners that are not constantly at the brink of bankruptcy. That's the joke part. Me and you both know what's happening with the miners, right? So I think that's it. Basically, that's what's going to happen.
There's not much domestic silver production, Eric. But do you mean, let's say, Mexican silver, for example, or South American silver? Yes,
those are U.S. companies, though, huh? They're owned by Americans. They're owned by Canadians, right? Mm-hmm. That's what I'm talking about. Like even mines in Africa, a lot of them are owned by American companies. So anyway, the whole point is those companies need to thrive in order for Donald Trump's Make America Great Again, reindustrialize, reshoring to work. Mm-hmm. And it's no longer in their interest to suppress silver at a joke of a price, $32 is ridiculous, and to help China doesn't make any sense. Especially now that we're in a mining deficit of around 8,000 metric tons per year.
8,000 tons per year is the deficit.
It's the mining deficit. Okay. And the LBMA claims that they have 27,000 metric tons in their vault. Do you believe that? I mean, they pretty much lied about the gold figure, right? Or obfuscated it. I don't trust them, 27,000 tons, because the SGE and the SHE, which are the two, the Shanghai Gold Exchange and the Shanghai Futures Exchange, the silver vaults there combined only have around, on a continual basis, only around 3,000 metric tons. So the LBMA is claiming that they have 10 times the amount of physical silver versus the Chinese. I'm sorry, it's not believable at this point, in my opinion.
I just don't know how that number of 8,000 metric tons deficit per year seems high to me, but I can't think of that off the top of my head here.
That's from the Silver Institute.
Okay.
That number. So I just simply converted I know it's confusing because the Silver Institute, they report that number in troy ounces. And I converted it to metric tons because China uses metric tons.
Mm-hmm.
So I converted it to metric tons so that I can compare, right?
Yeah.
The two numbers.
Yeah.
So 8,000 is what the world mining supply is 22,700.
Mm-hmm.
Sorry, 27,000. 27,000 metric tons is the world mining supply of physical silver.
Yeah.
But the deficit is 8,000. Okay. And the LBMA claims that they have 27,000 approximately, or 28,000 in the both.
Well, I guess we can only speculate on if it's there or not.
Correct.
And again, taking this step back, I think this has been an important catalyst to bring attention back to the gold market and probably sort some of these ways of this obfuscation and this opacity within the gold market to settle some of that.
Yes, I hope that my explanation of the EFP mechanism and how it normally works and how it is blowing up in the current environment will help your listeners today. Thank you for giving me this opportunity, Tom.
Well, really I appreciate it as well, Eric. And I hope this does help. This explanation does help a lot of people. You're going to have a thread on your Twitter to help explain a lot of this as well that you're going to have up within the next day or two here. We're recording this on Thursday the 20th, but we'll have it out on the 21st here. And you'll have that thread available on Twitter at KingKong9888. And if anybody has any other questions, they can ask you questions there as well.
Yes. Thank you, Tom.
Perfect. Thank you, Eric. Really appreciate your time today and look forward to seeing how this develops.
Have a nice day, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.